Hi, welcome to CEO Diaries Season 2. We have with us Mr. Ganesh Mohan, CEO for Bajaj Finserv Asset Management Company. To introduce Ganesh, Ganesh has been in IIT Kharagpur and IIM Calcutta Finance and Strategy MBA. Ganesh has been associated with BCG as a partner for the last for 16 years, and post which he joined Bajaj Finserv as a group head of strategy in 2015. 2021, he took over as a CEO for Bajaj Finserv Asset Management Company. Since then, he's been driving the asset management company for the group Bajaj Finserv. First question that arises out of your introduction itself is the fact that it's a totally different ball game. Getting into first finance and strategy, being a part of the partner in BCG, and doing into strategy for Bajaj Finserv, and then into a role of an asset management company. How do you see this journey?
So I worked with BCG across multiple markets, right? US, Middle East, Europe, India. And a lot of my clients were actually banks, but also sovereign wealth funds, asset managers, hedge funds. So this area actually interested me a lot because it's one where you're generating wealth for investors. It is one where with little capital you can actually generate quite a lot of business and you can be managing a lot of money. And this is a business where I was seeing that in India there is a huge potential for growth, which is not yet being tapped. So when I joined Bajaj Finserv, one of the key things that we were looking at in the strategy team was also that we were present in some businesses like lending and insurance. But asset management was the key manufacturing area that we were still missing out on. If you want to be a retail-oriented financial services player, you need to have a presence in this space. So we were very convinced about that. And so we decided that we need to build that presence in this industry. We decided there are two options that you can take. You can either buy. There were many transactions as well. Like in the last 25 years, there have been more than 35 M&A transactions in the asset management. But we actually decided to build because we want to create a differentiated asset management business. We want to bring something unique, something different to the industry. And clearly we could see the opportunity space is immense. Because at the time when we were launching, there were about 4 crore unique investors. Today there are about 5 and a bit. But we see the opportunity as one where the industry should be having at least 25 to 50 crore investors. That's the opportunity size in front of us. So for me, this is a very exciting space and one that I was very keen to help the group expand into this space.
That brings me to my second question. Asset management company per se is about now 68 lakh crores, a mutual fund, AUMs. Don't you think it's a late entrant to the asset management company? And how do you foresee your story into it? By the way, congratulations on almost 20,000 crores of corpus in less than 2 years. I think you guys are one of the fastest growing asset management company in India. That's something that we want to know a little more about, how you did it and what all things are working. But initially on the lines of the late entrant and the advantage of being a late entrant also.
So it's a very interesting perspective, right? So my own view is from that of an outsider in a sense. Right? Many people in the industry, they've seen the industry maybe over the last 30 years even. And for them, when the industry became 5 lakh crores, it was a very big occasion. 50 lakh crores was
massive, yeah.
Big industry but the opportunity has still so much more that is still ahead of us. We see this industry as having the potential to reach about 150 lakh crores definitely by 2030. And probably much more, right, in the coming years. We've seen other markets which have gone through the journey of GDP per capita of $2,500 to $5,000, which is what we will see in the next 5-6 years. At that time, when GDP expands 2 times, mutual fund AUM actually increases 3.5-4 times. For us, that journey is going to happen in the coming years. So these kinds of growth rates, very, very few other industries are yet able to offer. And this is an industry that almost blindfolded see about 20-25% growth rate year on year. So that kind of a growth rate, the number of new investors that are still to come into this industry, and the ability to generate wealth for Indians, right, is a huge option. So we decided that we'll come into this industry and we will look to capitalize on that growth as well. But for us, it was very important that we come in with sort of a new thinking, right? Bring something unique to the market. We didn't just want to be the 41st player and check the box that, okay, we are present in this.
We are also doing this.
But we must try to bring something new and unique. Because otherwise, when people have 40 options, they can work with anybody.
Absolutely.
They have a longer term track record. Why should they come to us? So for us, a lot of the growth that we've seen, which you referred to the page, partly of course is the brand is a very strong one, but partly also is because the kind of propositions that we brought have been quite differentiated, and propositions both for investors as well as for our distribution partners. So investors, one of the key things that we thought we should bring are things that we were seeing outside India which were working well, good practices, right? And this is again a late mover advantage. Right? We can actually see what has worked outside, what has not worked, what has worked in India, not worked, and you can take the best of all worlds and bring that in. You can rethink your processes from the ground up. Nobody's telling you that this is how it has always been done. Right? So sometimes you can just fundamentally challenge a lot of things and try to think them in a different and hopefully better way. One of the things that we are seeing very clearly that a lot of global asset managers are using behavioral finance that include investments. That we were not seeing so much in India. Nobody was talking about that at that time. And this is quite an important area because behavioral finance, when you apply that along with economics, you get a much better view of the market. See, economics itself is a very important discipline. But in the very first class of economics, the professor will tell you to make two simplifying assumptions. One is all human beings are perfectly rational. Second, markets are perfectly rational. Both of them, I think we know, are not true.
Not true.
Right? So it's a little bit like saying that three angles of a triangle don't add up to 180 degrees. But I'll teach you a course in advanced geometry. I'm not saying economics is not important, but when you apply a layer of behavioral finance on top of that, you actually get a more refined model to understand the market. So that is something we fundamentally did, that we must bring something unique to the behavioral finance into the field of investing. We brought that into our investment philosophy itself. We said the three sources of alpha would be information edge, which is when you have better quality information or earlier information than the crowd. The quantitative edge, which is how do you process that information. The third is the behavioral edge. We call it InQ. It's information, quantitative, and behavioral.
Wow, this is very interesting. In fact, I saw that there are a lot of large fund houses which are known for their value investment, for their contrarian strategy, for innovation and bringing up new funds. How do you want Bajaj Finserv AMC to be known as in the industry?
So it's a very interesting question, because a lot of people asked us this question in the last year and a half. What is your style? Are you a growth investor, value investor, quality? And we tell them one very simple thing: we are a common sense fund house. It fundamentally boils down to that. If you're in a market like India, right, you want your companies to have growth. Otherwise, it's meaningless. Second, will you buy growth at any price? No. So you certainly will look for value as well. Definitely companies that have good quality management, good quality businesses, protect their earnings for a longer period of time, justify higher multiples. So you definitely look for that as well. And you also want to make sure that these are good, well-governed, ethical companies. So you want to look for all of these metrics when you're making the investment call. So for us, it's very important that we check all of these boxes before we get into any investment. So rather than saying that we have a specific style, we actually say that all these styles have merits. Why should you not incorporate all of them? See, what often happens is a style is often used as an excuse. Right? When you're not performing, then you can say, I'm a quality investor, Ravi quality ka time nahi chal raha hai.
Okay.
That should not be an excuse. You have to be able to find ways to perform in different cycles of the life. That's the approach that we take.
Interesting. So I keep saying that trends are more important than the levels of the market. And we've already seen that, because all-time high actually beats the all-time high in the same year also. There are many trends like that. What would be some of the trends that you are noticing right now, which probably are some of the areas where Bajaj Finserv as an AMC would want to work on?
So a few things that we do is we actually pioneered something called mega trends. Now, mega trends are like ocean currents.
Which is why I asked you this question.
So CIO wrote a book on mega trend investing. In fact, I think it's the first time that in an AMC, the CIO has written a book about how he's going to invest before launching
the fund. Okay.
Before launching our flexi capital based on mega trend investing. And Ganesh wrote that book. And in that he talks about the different mega trends. And there's a very simple mnemonic to actually remember it. So we call it T for technology changes, R for regulatory changes, E for economic shifts, N for nature or environmental changes, D for demographic changes, S for social changes.
Okay.
It's an easy way to remember it as well. What we look at is companies are benefiting from any of these mega trends. Right? It's like the big ocean current is taking your boat anyway faster. So if you're navigating along with it, you're likely to go faster. But if you're navigating against it, it's very difficult for you to go. So I take an example, you look at an EV company versus, let's say, a pesticide kind of company. I'm just taking as an example. Now, an EV company, obviously there's a lot of technology and development that is happening in there. It supports it. Regulatory, but there's a lot of subsidies as well that are happening. And nature and environmental, a lot of people are getting more aware of. So you have a lot of these mega trends supporting the EV company. Now look at a pesticide company. Right? Technology is actually working against it. The newer technology is bringing out seeds that require lesser pesticides. Right? Nature or environmental awareness, people actually want whole foods, organic less pesticide foods. So between these two companies, when you just apply the trends framework, you get a better sense of which company is more likely to grow faster than the others. So that's how we systematically look at sort of the trends in the market. And interestingly, when we applied this and we saw the portfolio that was coming out of it, we saw that mega trends can benefit any company. It can be a large, mid, small. Therefore, we decided to house it in the flexi cap. Thought process comes from what kind of active strategies can outperform passive. Based on that, what's the portfolio? Based on the portfolio, what is the right fund structure? Rather than to say, flexi cap is a 4 lakh crore, market opportunity. Let me put one more fund in there. So with everything we try to come to the differentiated thought process.
You just mentioned about the passive strategies, and there's been a lot of debate about it, like active versus passive for a while. And barring the last 2 years, I think passives have done better than the actives. Where do you see this active and passive debate today?
It's a very important discussion point, right? Because there's a lot of debate around this, that will active even survive, what kind of active strategies would work. So we did a couple of things. We looked at markets where actives and passives have competed for a longer period of time. Markets like the US, Europe. While in the US, of course, passives have grown a lot. But there are still some active strategies that are held on. And are still generating alpha. Same thing in Europe as well. So we try to get some learnings from there. And what we found is you have to systematically look at what are the weaknesses of passive. What is it that passive cannot do? If your active funds are doing that, then you have a reason to outperform. I'm not saying it's a guarantee, but it's a reason to outperform. That has to be there. So we looked at it and we saw that there are two major weaknesses that passive has. First is passive cannot look into the future. Right? When do companies come into the index? After they perform. Right? So Infosys came into Sensex in March 2000. After the entire Y2K run. Like you may remember that after that for 2 years, it actually
underperformed. Yeah.
Zomato was coming to large cap index now.
After it's already run up there for a big run.
So that's one part of it. Second part of it, index will have some companies that are underperforming. They will stay in the index till they exit. Index has to invest in it, even though you know that they will probably not generate those kind of returns. So that's why if you have a systematic strategy which looks at which companies can grow well in the future, which is where we come to mega trends, then you have a reason to outperform the underlying passive. So that was the basis of our first one, which was on the mega trends. The active strategy which can outdo passive. Second weakness that we saw of passives. Passive does not care about quality of company. Whatever the company, whether it is a PSU, a private sector, good quality management, good business model, it does not care. If it's in the index, it's in this. But you see, good businesses, strong economic modes, good management, good governance, tend to outperform in the long run. And that's why they get able to hold on their profit streams for a much longer period of time. And justify higher multiples. So that's why we came up with this concept of mode-based investing. Companies that have strong economic modes, that protect their business models well, those again can outperform compared to a passive strategy. And these strategies, basically you would see that they tend to develop a mode, you need to have some level of resources. Right? So therefore, large and mid cap is typically where you will find. That's why we housed our mode-based strategy in a large and mid cap.
Large and mid cap. Nice.
So that's the broad thinking of how we try to bring the concepts from active versus passive to specific funds.
Will we see Bajaj Finserv offering passive strategies?
So we do. See, clearly there is a market for passives.
Hmm.
And some investors, a lot of new investors, for their first investment in the markets, very often a passive is probably the right one. So we do already have, we have a Nifty ETF, we have a Bank Nifty ETF, we have a liquid ETF as well. Even for some institutional investors, passives very often becomes the choice that they
entry point is,
invest in. We do have that. But all our active strategies, we try to do what passive cannot. So that there is a clear reason for both to exist.
Nice. Coming back to the portfolio and the strategies is very interesting actually, but I'll come back to it, a little later. I would rather touch base upon the macros and the budget. Now that the euphoria of the budget has actually settled down a little bit, so what is your view on the budget now? How do you think the budget was?
Yeah, so I think quite a good budget is our view. So it does a few critical things that we are looking for. First is the fiscal consolidation. I think that is something which we've been seeing a good glide path, and the government is committed to it and is demonstrating that it is going to continue that commitment. 4.8 this year, going to 4.4% of GDP next year. I think it's a very good. It creates room for stabilization by RBI. It also sets up the ground for clear credit re-rating over a period of time. So I think that's a very good macro development that the government is continuing to push. The second thing was on the tax cuts. I think everybody has discussed it quite a lot. Very important. What does it spurs predominantly urban consumption, right? Which I think was clearly the area that was beginning to suffer. I think was under some stress. So this certainly provides some level of relief for a large number of taxpayers, right? So that I think was something which is good. You put money in the hands of people, that's always a good thing. Plus, it will also lead to some level of saving with them. So how do you will also invest in the market? I think that's good for our industry as well. So I think 1 lakh crore coming into the market, of it maybe 20-30% is savings and 70-80% is investment. Is consumption. That actually is a good driver also for the GDP as well for the coming years. Plus, I think for a bunch of different sectors, agriculture, SME, there are a lot of things that the government has announced, which I think are all measures in the right direction. And I think it's that way, it's something which is really a futuristic budget. And I think government has given a very clear statement of intent that they've heard, the concerns from the middle class. They're not overly pandering to, giving out freebies. That is not, the focus. Fiscal consolidation is still very much, required. And the monetization of assets is something that they're also committing. So, in terms of the statement of intent, which is what we look at it from a budget perspective, I think that statement is a very positive one. So, we are quite enthused and energized.
So, a couple of things that I saw you guys doing with Bajaj Finserv AMC doing is also identifying the trends a little early on. Like, for example, we've seen that when the per capita income of a nation increases to $2,500, the story for the nation, whether it is US or China, is completely different. And we've seen it in both the stories, both the economic upside, whether it is US, whether it is China. We crossed it about 2.5-3 years ago. And we are on our way to be probably a $5,000 scenario in the next 3 to 5 years. What I saw was still that the consumption story that we were building on, was not taking off as well as it should have been. But you guys came up with a consumption, fund, and then you backed it up with a healthcare fund. And I think probably the first ones to do that in the industry. What made you, do that?
So consumption is, I would say, a sectoral story of almost a decade that is yet to come. Why do I say that? Consumption, when your GDP per capita is around $2,500, about 40-45% of that is on spending on basic items like food and things like that. That is survival consumption. And that goes to $5,000, probably where we will be in about 6-7 years' time. That becomes that 40% of around 10-15%. Now, larger income, you have 80-85% available for spending in other areas. Services, eating out, beverages, housing, durables. It's like a huge, focus of that surge and wave of spending goes into those sectors. So every economy that we've seen this kind of GDP shift in, right, causes that massive change. See, in India, what there is, people tend to think of it as one country, but from an economic perspective, there is in India, there is an Australia, there is a Philippines, and there's also Sub-Saharan Africa. Right? What is happening in the next 5 to 7 years? Sub-Saharan Africa becomes the Philippines, Philippines becomes an Australia, and Australia becomes a Switzerland. Right? So the consumption patterns and behaviors of each of these segments shift very dramatically. What we are trying to do is seeing that as a trend, capturing the increased consumption, the change in consumption patterns of each of these segments. So that was our story behind the consumption patterns. We strongly believe it's really the story of the decade. Plus, as you were mentioning, the market had not been sort of rewarding consumption stories because of some short-term stress that we are seeing also in the market. So you're getting consumption names, right? The kind of portfolio that we built up, you're getting it at very good valuations. Themselves in the past and also related to the broader market. So you're getting a great story, which is a very strong long-term growth potential. You're getting it at a very good valuation. So that to us is an excellent investment option. Healthcare is a very different sector, right? Again, healthcare, like consumption, is multiple sectors put together. You have pharma, you have diagnostics, you have wellness, you have equipment, you have contract research. So there's again multiple sectors that come in there. But it's very, very uncorrelated with anything else that's happening in the economy. No matter what Trump does, no matter whether there's a rate cut or not, healthcare continues. So requirements for that, focus of the government on health insurance and providing good quality healthcare. Budget they talk about 100 cancer centers across districts across the country. Focus is going to continue. So we see this as a largely uncorrelated play with significant growth tailwinds as well. Things like the US Biosecure Act. So they want to move all of their data and contract research, clinical research away from China. Opens up significant opportunities for markets again. This is again a multi-year kind of a play, which is quite diversified. Again, it allows you to play in multiple sectors. So that's really the thought process behind the two thematics that we launched. And even though they're called thematics, they're actually multi-sector and almost quasi sort of broad market indices, particularly on the consumption.
So that's interesting actually, and that's you guys are the first one to actually identify and probably launch it also. So it was pretty interesting to know that what has been the thought process behind it. 4 to 5 months ago, a lot of people were very positive about the Indian markets, and for the last 4 months, month on month, markets have been correcting. In fact, in Jan also, markets corrected by about 4.6%. On the contrary, even mid and small corrected by more than 20%. They've gone into the bearish category where we say that we should buy more than selling. So what has gone wrong according to you?
Large cap is one that we are very clearly seeing a lot more comfort in terms of the risk-reward equation, in terms of liquidity, and as and when the FIIs come back, the flows will also support it. But there was initially the first 3 months of the 4 months that you mentioned, the correction was more because of the FII development, which affected the large cap market. Last couple of months, what has happened is the shift has actually been more on the mid and small, which indicates retail selling. Right? Now, that is predominantly happening partly because valuations are stretched. Small caps, right? As a sector, not necessarily every company, but certainly as a sector, they have been stretched. Mid caps were trading at close to about 2 standard deviations higher than long-term average. Small cap trading 1 standard deviation higher. So clearly, from an incremental investments perspective, the risk reward becomes much more difficult. You have to do a whole lot more research to identify which are the potential winners from there onwards. The bigger question is actually the liquidity in some of these mid cap and small cap names. Many of them are not very highly traded stocks, right? And with very small volumes, right? The price can move quite significantly. Both the mid cap and small cap. Now, while entering, it's still possible because the promoter will probably give you entry. But when day trade volumes are very low, exit becomes very challenging. So I think part of what we're seeing is also some of that. With some of the fully traded stocks, where let's say the free float is very low, and even a small shift in trading volumes can cause significant price correction. Coupled with high existing valuations, that's what has caused the impact here. And my sense is those kind of stories, there will continue to be some pressure on those. And this is the time when people much more conscious and do a more bottom-up approach. See which companies actually have good growth potential, where are we seeing good order books, good quality management, plus where the people are not too limited that a few crores can cause a huge price spike. Right? So I think those are things that people will have to now start observing and watching a little bit more carefully. And that's what fund managers also will have to now navigate much more.
One key point that you mentioned was on the digital and technology. India is also known as one of the countries to fast adopt the digital technology. How do you see digital and technology space been utilized by first Bajaj Finserv as an AMC and its own scope in the Indian scheme of things?
So let me cover the digital and technology bits, because Bajaj Finserv generally is known for technology and the approach that we bring using technology in our business. So we were seeing the same opportunity, Kalpesh, in the asset management space. Right? And we said day-to-day technologies, things that people use on a daily basis. Why can we not bring that into the asset management space? So we took a simple example. Should we build our own app or not? And we said, why? Why should we build our own app? How many investors are going to download multiple AMCs apps? How many distributors are going to download 10, 15 AMCs apps? Instead, we said everybody's got something on their phone already, which is WhatsApp.
Yes.
Why can we not use that? And we started our empanelment journey from there. We got 25,000 distributors to empanel with us on WhatsApp.
Oh, wow, that's
within a minute.
huh? Oh,
It's a 1 minute journey to empanel with us. So even before we launched our first fund, we had 25,000 distributors empaneled.
wow.
So that also helps, right?
Absolutely. Yeah.
Second, we said, why stop here? Right? Why can we not make WhatsApp a full-fledged transaction channel? So today you can do lump sum, SIP, redemption, you can do non-commercial transactions. If you want to have application forms, you can download it. You can get fund fact sheets, everything. You don't even need to call my RM.
Okay.
Right? You can download it on WhatsApp. Second example, QR codes. They're used. Every Indian now uses QR codes.
Everybody's using it.
On the asset management business, nobody can using it. So we said, why can we not create custom QR codes for each of our distributors? Right? In that, anybody scans and invests, your ARN is already hard-coded.
Okay.
Right? Second, we added to that, we said, can we also have a scheme-specific QR code? So let's say you, as a distributor, if you put that QR code, you can pre-fill the scheme details also. The ARN is also pre-filled, you cannot edit. All the customer has to do is, once he enters his PAN, he has a folio already in the industry. We download all the details also, so that also gets pre-filled. Customer only has to pay. So you send a QR code, customer just puts his PAN, pays, done.
Nice.
So what we try to do is simplify the entire journey for our investors, for our distributors, using day-to-day technology. Nothing very fancy, nothing complex. These are the things that everybody
is using. Yeah, with the QR code or WhatsApp.
Yeah, and that's what we believe will really cause many more investors, many more distributors to also firstly expand the business, also start considering mutual funds, and we have to simplify the whole process of business. So that's what we did. But technology gives us the ability to launch into whole new areas as well. So I'll talk about one thing that we launched very recently, something called Savings Plus. Now, Savings Plus is something where most of us, we all have a savings account. And I can guarantee that all of us keep extra money in our savings. And historically, there were reasons, we all never knew when an emergency might come, just keep a little extra. But that we earn typically between 2.7 to 3.5% on our savings. As a financial advisor, you would never advise your client to have money in a product that is giving you 3.5% return, fully taxable. So we said that that's an inefficiency. And today, using something called account aggregator, which RBI has introduced recently, there is a way in which we can, with customer consent, can analyze the last 6 months bank statement. Based on that, we can tell the investor how much surplus amount he has been keeping in their savings. And if this had been, let's say, deployed in liquid, how much incremental return that
you would have made it.
Nothing about it. This is your own hard-earned money working harder for you. So for the investor, it's a very powerful proposition. And in India, you have people who have totally 20 lakh crores sitting in savings accounts. 20 lakh crores. Now, with the return gap between savings as well as, let's say, liquid funds, that translates to 80,000 crores of lost interest.
Okay.
The simple equation is if you keep 1 lakh extra in your savings account, it's like 10 rupees a day. 10 rupees every day for each lakh that you invest in. So this is something where we believe that to expand the industry, to go from 5 crores to 25 and hopefully even 50 crore investors at some point, we should have a product that everybody needs. And anybody who has a savings account can benefit from something. So this is something which we are very keen on doing. And a similar product which was launched in China, and Financial had launched this, that became the world's largest money market.
Oh, okay. Nice.
And again, there the return gap is around 3 to 4%. So very, very similar, large market, the return gap is there. We see a lot of potential for something like this. And it's definitely something which is very much in investors' interest. So I think that's something we are very keen on. How do we bring new and new technologies into the hands of our investors as well as distributors?
Last 2 years, the growth has been fabulous for you and also for the industry per se. What do you see? I want to know 2 pointers actually. What do you see lies ahead for the industry, asset management industry? And what will be your strategy going ahead?
So if I look at the last few years, Kalpesh, what I've seen is, if you're following Formula One, right, typically there's a racetrack section which is called the straights. So last 2-3 years have been a bit like that. Right? You just show up, the more gas you have in your tank, the more you hit the pedal with the metal, you'll do it. You don't have to worry too much about risk, tire pressure and all. You're now approaching the bench. Right? This is when you have to slow down, you have to watch a little bit, what speed do I take this curve at, is there moisture on the track, how are my tires doing? You have to be a lot more cautious and watchful. And a lot of these curves and complexities are both, I would say, partly domestic, but mostly actually coming from outside India. And that's where the unknowns are really coming from. So the market is not fully priced in these unknowns at this point in time, because we just don't know what to price. Whether it is Trump deciding to put tariffs one day, then backing out the next day, what happens in China, what happens to global trade, what happens to inflation, what happens to geopolitical risks. These are all very, very high levels of unknowns. So these are times when a fund manager has to have his hands on the wheel. This becomes very, very important. Proactive decision making becomes very important. Quality of the portfolio becomes very important. So what we are seeing is 2025 particularly is probably a year of 2 halves. First half being where a lot of this volatility will play out. You will start understanding what exactly is going to happen. I don't think fully that has happened yet. And once they have understood it, then they priced in, that's when the market will really take a direction, which we anticipate will happen closer to the second half of this year. So that's sort of how we're seeing the near-term picture. Of course, longer term, India is very, very well positioned. And I think our economics, our demographics, the way the domestic consumption story is still very much intact. I think all of those are very much in the favor of the country. So long term, we are very, very bullish. Near term, you have to be more watchful. That's for the industry. For us, we are still a very, very young fund house. So there's a lot more for us to do. We have, at last count, only about 17 funds. There's a lot more that we need to still launch. But of course, we have to continually watch the space. We are managing all our funds. We look at active share, risk-adjusted returns. We make sure that all our portfolios are built right. And we continue to engage with the market as well. We continue to invest in new technologies. We make sure that for both our investors and distributors, we're giving them easier ways to interact with us. And for our distributors, easier ways for them to build their business. So those are some of our priorities at Bajaj Finserv AMC.
Oh, that's really nice. Couple of pointers that you would want to share with the relationship managers now. Any pointers that you would want to share by who are managing portfolios for the clients?
What I would tell all relationship managers is, this is the time to go on the front foot. I've seen there are quite a few relationship managers who, let's say the portfolio sees a little bit of a dip, they
vanish.
That's actually the wrong thing to do. Because you are actually deserting your client when he needs you the most. So you go on the front foot. This is the time when they need you to come to them, explain to them what is happening, give them a better understanding of the market, and more importantly, help them not to act against their own interests. See, Benjamin Graham, who's the author of the Value Investing, the Intelligent Investor, he actually talked about the fact that in this book we will talk a lot about the investor himself. So the chief enemy of the investor is the investor himself. Right? So what happens is, on a day like let's say a difficult day is there in the markets, next day you'll have a news article, 7 lakh crores of market cap eroded, investors well destroyed. how does an investor feel at that point?
For 500 billion like Nivede.
Exactly. So they will make a sense of panic. And today's day and age, it's very easy to act on that panic. Right? You pick up your phone, you can pause an SIP, trigger a redemption. It's very easy to do that. What has the investor done? He has locked in that loss on that day. Okay? Let's say 2 days later the market comes up and then he wants to come back in. Again, he's now locked in on both sides. He's locked in a definite loss. Okay? Now, this is the reason why when you look at the data, the difference between a fund returns and folio returns. Right? In the same fund, over a long period of time, let's say 3 years, 5 years, across fund types, tends to be around 2.5 to 5% annually.
Okay.
Think about it. If the fund is returning 15% long term, investors are getting between 10 to 12.5%.
Okay.
Because of
this.
Now, this is something which I call advisor alpha. This 2.5 to 5% gap is in your hands. You are able to control the behavior of your investors. Make sure they don't behave against their self-interest. This is what all RMs should be, proactively. See, we talk in this industry about fund manager alpha. That may be a few basis points, maybe 100 basis points. Or the alpha is close to 250 to 500 basis points.
Which is very high.
Right? If you can deliver that to your investors, nobody's going to be asking you about commissions. The conversation changes completely towards what have you delivered in terms of value to the investor. So my biggest advice to all RMs is, you are in a relationship business, you are a trusted advisor. Right? Make sure that you help your investors avoid the mistakes that they typically make at this time. And these times are when you really earn your money. So don't go on the back foot. Please go on the front foot.
Well, that's really nice, Ganesh. And thank you so much for being on the show. And I think we got a lot of insights. In fact, most of it was from the strategy point of view. So this has been a very interesting conversation. Thanks for being here. Thank you so much.
Thank you very much for having me.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.